Guys, good afternoon and welcome to the CNBC-TV18 Mumbai newsroom. I'm Pavitra, with me is Sonal, and you're tuned into MF Corner. Today we're going to talk about all about smart beta or factor investing. This is a strategy that essentially combines the benefits of both active and the passive investment styles by applying well-established factors which are used in active investment and then the rules-based framework of passive investment. So it's very interesting. Stocks are picked by this approach and they're selected and weighted in a portfolio based on various factors. Momentum, volatility, all of that. So there's a whole range of options which is available in this strategy as well. So let's invite the SBI MF team and learn more about this.
Oh yes, let's do that. Let's welcome DP Singh, the Deputy Managing Director and Chief Officer at SBI MF, and accompanying him is Ruchit Mehta, who's Head of Research at SBI MF. Gentlemen, good afternoon. Thank you so much for joining us today on this interesting topic and explaining to our viewers as well. Mr. Singh, let me start with you then. What is factor investing and why do you think a strategy like this is needed when you look at mutual fund investing?
Yeah, thank you. Thanks very much for having us on the show, first of all. And see, as far as factor investing or smart beta is concerned, see what happens, it is generally whenever we are having some parameters, or this is always a market cap benchmark. But there is another way of doing it, and the rule based, like you preset the rules that I will not put more than this particular percentage in a particular stock. So that is something which is done to have a lower drawdown. And see, we have seen when we did the back testing, we saw over the different periods the smart beta strategy, especially this if we talk about the equal weight or something which we are up and running in NFO. So these kind of strategies generally outperform. And second, there's always a debate on the active versus passive. So when it is there, we feel that there's a niche which is definitely prefers the active, and there's a particular niche which want to do it passively, and that too, especially the world investor want to do it rule based. So this factor investing is nothing but a preset rule based investing, not linked to the market cap and the particular say index, but on the basis of whatever we feel will do better in times to come.
Okay, and it also cuts volatility a great deal, right? Because you're not allocating a huge chunk to any one specific stock and you're pre-deciding that. Ruchit, let me come to you first. Do you want to just take us through some of the different factor strategies? Like I was mentioning, you know, this can be based on various different kinds of models, but take us through some that are commonly used.
Sure. So traditionally, there have been four factors used in rule-based investing, right? So you've got growth, value, quality, and momentum. And in each factor, right, you're looking at a subset of parameters to try and rank individual stocks. Right? So for example, when you're looking at the value factor, you're looking at various relative valuation parameters as well as certain absolute parameters, like say, for example, looking at the dividend yield of a company, and then ranking stocks on the basis of the yield that they offer, or if you're looking at relative valuation, then the multiples of the company vis-a-vis either the sector or the industry or their peer set. If you're going to look at, say, momentum, right, it's very simple. You're looking at stocks which have done the best and the worst, and you rank them accordingly, which tells you that which stocks are in momentum and which stocks are out of momentum. You have quality as a factor where you're essentially looking at how good is the business per se. So you're looking at parameters such as return on quality, how stable have been earnings over, say, a 10-year cycle vis-a-vis the peer set, how volatile have been the earnings. And then you're looking at growth factor, right, where you essentially are seeing that how is the growth for the company vis-a-vis the peers in the industry. So you would look for change at the margin in terms of how is the trailing 12 months growth, how is the estimates forecast changing or not changing. So those are various parameters you would traditionally look at. But beyond this, I think the rule-based investing has gone into other areas as well. So for example, you can look at minimum variance, right, where you really are trying to sort of reduce the volatility of a fund by working on the variance of individual stocks vis-a-vis each other. So try and reduce the volatility because of the correlation factor. Then you can also have multi-factor funds where you can use size as a factor, you can use quality or momentum as a factor. So you can use a combination of various factors to create a multi-factor based portfolio as well.
Okay, all right, take that point. We'll just come back to you, but Mr. Singh, let me ask you the other side of this question. What helps an investor decide which factor works for them? Or does it have to do anything with market conditions? Is it a portfolio construct? How can they look at the strategy?
Now, basically, they have to look at the strategy in a way, especially in a bull run, which we have seen in the last 5 to 6 years, 7 years. We have seen so many, like one-sided things happen in the market. For example, recently you would have seen, because of beating of one particular stock, the whole the index came down, crashing down, and 50 to 60% crash came because of the one particular stock. To mitigate such kind of risks, it's always possible to have a decided rules, so that we can see help people stopping the drawdown. And see, or as said, we are having such a big market, and there is every kind of niche which we have to serve. So we have to have a complete bouquet. Whosoever feels that, we being manufacturers, we will come out with all kind of funds. And definitely, while designing the scheme, we always keep the investor in our mind. What is good for the investor, and how can I offer a scheme, which offer a fund which is suitable for a particular niche. So this kind of fund, when we do it, then we always see that what all strategies can be brought in, and the presentation is given, the everything what we feel, back testing is done, whole lot of homework is done before launching such a strategy. It's not just, it's never, it fits everybody a particular scheme. So that's how we want to create a complete bouquet of passive funds, starting with this thing. The mainline funds are already there. Like you got talk of Nifty 50, you got talk of Nifty banking, you got of BSE 30. So all these kind of ETF and index funds are there. But if you want to come to a specific strategy and specific thing, and research shows that you can create some value for the investor, then definitely there's always a room for this thing. Like we have SBI Nifty 200 quality. Out of 200 stocks, we are putting only 30 stocks. And if we look at the returns, for whatever period you see, this strategy has always worked, and it has given a higher return from the baseline benchmark which is there. So this gives us more confidence, more and more NFOs we keep on coming. Now whatever is there on offer is equal weight index. So top 50 stocks will put around 2% in each and every stock, so that we are able to create value, because we see that the way our country, our economy is as on date, and we see that we are the sweetest spot. So all the good businesses, so naturally top 50 companies are the best, run more with the highest level of corporate governance are there. We want people to participate equally in all those stocks, and we are of the opinion that going forward this will give better results.
Okay, got that, and definitely take your point, and you wanting to offer the entire basket of options that is available within the passive space. But Mr. Singh, tell me, are you saying that if you already have an index fund, so if I already have a Nifty 50 fund, do you think the Nifty equal weight would be complementary, and maybe I should have both, because they will perform in different market scenarios, right? So does it make sense for someone who holds the frontline index to also get into a new fund like this?
Yeah, definitely. If I am an investor, I will do that. But again, as I said, we being manufacturer, we can't we don't want to influence the thought process of any investor. We can put it on offer. We are confident that this will do better. But at the same time, people have to take their own call. But definitely, this is not something fit for a person who is already into various kind of funds. For the newcomer who is starting his investment journey, starting with large caps, and starting the people who are putting money in the fiduciary capacity, like trusts, etc. So this strategy will work very, very well, because they are not taking very, very strong calls, and this fund will at least make sure that they are participating in all the good businesses of the country, the top 50 businesses of the country, in an equal manner. So definitely, if it is possible for me to have more surplus fund, then I will go for it in addition to Nifty 50. But if I am not having surplus fund, that part of the money which is Nifty 50 can definitely be put in this scheme as well.
Okay, take that point. Thank you for that explanation. But Ruchit, let me come to you. All things being equal, what differentiates one such factor fund from another would be the tracking error, right? So can you explain what gives rise to tracking error, and how do you manage to minimize it? What is tracking error? This is for benefit of our viewers who are investing in index funds.
Sure. Simply speaking, tracking error is the difference between the performance of the fund versus the performance of the index. Now, there can be operational challenges in terms of replicating the performance of a fund, right? Let's say, for example, if you take a small cap index fund, you have to invest into about 250 odd securities. The liquidity of every security may not be the same, and therefore it creates an operational challenge. Therefore, how well does the fund manager deploy the inflows or manage the outflows into a fund so that he minimizes the difference between the fund's performance vis-a-vis the index? So that difference is what we call as a tracking error. And the lower the tracking error of a fund, the better it is for an investor, because essentially it means better performance and lower cost for the fund.
Okay, got that. That is, a helpful explanation. Ruchit, Mr. Singh, we have a lot more questions. We're going to come back to you in just a bit. But for now, we do have to take a short break. We will continue our conversation when we come back in just a bit on smart beta investing. Before we get into a break, I also want to quickly just, alert our viewers. The union budget is less than 10 days away now. So what is your wish list from the finance minister? We present to you the CNBC-TV18 budget ballot, where you can now share your budget expectations with us on our website by scanning the QR code on your screen or by logging on to cnbc-tv18.com/budget.
Welcome back. You're still tuned into MF Corner. We have with us DP Singh and Ruchit Mehta from SBI Mutual Fund. We are trying and understanding everything about smart beta investing. We've understood a lot of things in terms of what the smart beta funds look like and what are the categories in different funds that we are looking at here as well. But Mr. Singh, let me come to you, because we have understood what factor funds are like. But are these only for savvy investors?
No, not really. Actually, I will put it the other way around. This can be very good for the novice investor. It could be very good for the first-time investors. See, when we look at overall industry, the size of the industry today, we are having around 30 lakh crores of 32 lakh crores of overall equity business, and see, the passives are around 1/3. When, to be precise, it's at 8.7 lakh crores is the passive business, and around 28 lakh crore is the active business. In country like ours, where more and more businesses are getting into the listed space, and the number of listed companies growing every now and then, there's definitely a scope for having generating alpha in the active funds. But at the same time, the people who don't want to get into the fund manager bias, positive bias, of course, from our point of view, they can come into passive fund, and the passive funds are also growing. But these are growing more into the institutional class, but not in the retail class as of now. But if we look at the history of the global players, so globally it started like this only, and today passives are outnumbering the active numbers. So our market is not yet fully matured. More and more new businesses will be coming. So active will definitely play a good role. But along with the active, passive strategies are very, very solid, very rewarding and value-driven strategies where investors can definitely have a look into.
Okay, well, absolutely. And, like you mentioned, you don't have to be a very savvy or very experienced investor for this. This can work across the board. But Ruchit, that said, any risk that, investors should be wary of when investing in factor funds, or just maybe factors to consider, to be aware of when you get into this kind of fund?
Sure. I think it's very important that the investor looks at what is the factor that they're getting exposure to. Let's say in your portfolio, you have a very large allocation to small cap, mid caps, but typically they would have a very high degree of momentum and as well as growth as an underlying factor per se. So if you add another growth oriented or a momentum oriented factor fund in your portfolio, then you're just adding further to your risk profile. Rather, what you should be looking at perhaps is either a quality portfolio or a value portfolio. So it's very important that the investor looks at what is the underlying nature of the fund that they're getting an exposure to, what is the factor, how does the factor work, and in what market cycles that factor doesn't work as well, which is very important for them to take into consideration.
All right, so we take that point, but Mr. Singh, can you give us a sense of what is the cost of such funds typically like? Are they similar to index funds? Is there a big spread here?
Yeah, mostly the index fund. This is also an index fund. So index funds can be bracketed in one, and these are much cheaper than the active funds, but definitely a little costlier than the ETFs. So we'll put it in some in between ETFs and the active funds. So cost wise, definitely it's beneficial for the investor to put in index fund rather than the active funds. But the capability of active funds to create alpha over the period of time is much higher than the passive funds. When the kind of alpha which can be generated, when 1 or 2 years can be here or there. And one more thing, whosoever is coming, it could be active fund, it could be index fund, it could be ETF. The basic risks which are linked to the any equity investment need to be known, and the longevity of investment need to be kept in mind by any investor, because in short term getting very good returns is just a bonus. But if somebody wants to be in the equity market, the minimum period need to be, one should come with the thinking that I'll be there at least for 3 to 5 years. So that is something which is very important. The risk appetite is very important. Though it is absolutely clear that novice can come, it is first timer can also come, but the longevity of remaining in the fund needs to be more important than anything else.
I'm glad you placed that caution on board that whoever's entering, please don't look at any kind of equity investments with anything less than a 3 to 5 year kind of horizon. Mr. Singh, but what is your view on the overall future of passive funds in India? You know, you were mentioning this a little bit earlier that it's still picking up globally. Of course, passives are a big chunk of the overall amount. Where do you see India really moving, and how much do you think they can really take from actives in the near future?
The base like ETFs, etc., which is showing a good AUM, the majority of the investment is coming through the institutional investors, or the investment which is coming with the help of the RIAs and advisors. Our industry is basically B2B. And when there's no remuneration for the person in between, then it becomes little difficult for the baseline distributors to push it too much. But at the same time, this is something which will grow. This is the global trend which we have seen. And when investors in general get more involved, and which is happening in India in a big way, more and more number of investors are coming into the capital market, especially through mutual funds. And once people look at any other cycle, most of the investors who have come during the last 6-7 years, they have seen only one side of the market. They have not seen different cycles. But we, being the responsible investment managers, we always want that the retail should also grow, and it is growing actually, especially in the smart beta fund. So now earlier when we were coming out with an index fund, we were thinking that we'll get rapidly, 2-digit or 3-digit 10 crores AUM. But when now we are coming with the confidence that it will definitely be 4-digit kind of flows which will come, and do it yourself kind of the ease of investing, ease of doing business with mutual funds has become very important. We are seeing a very good traction into these funds. So we are hopeful that going forward, passives will definitely grow and grow much bigger than what we have seen during the last 5-6 years.
Okay, that's definitely good to hear. Ruchit, let me just come to you on the same thing as well. You know, how are you seeing passives really shape up? And within passives, how do you see the split? How much do you think goes to pure play sort of index funds? How much is going to smart beta and overall smart beta and to ETFs as well? You have, that kind of contribution with you?
So I think at this point in time, the market has predominantly been focused on index and ETFs, right? Plain vanilla products. Because this is something new to the Indian market. The investors are just getting an understanding of what is an index or what is an ETF fund per se. And things like smart beta and other variations of factor-based products are just about to take off. I think going forward from an incremental standpoint, especially on the retail and the HNI side of it, we would anticipate that you should see greater flows into smart beta or active sort of more of factor-based products rather than just pure index or ETFs. And I think index and ETFs will remain the flavor for a lot of the institutional market, given that it's a simpler product, it's an easier product, and it essentially offers an exposure to the market without any variation on it. But the others, factor-based stuff, I think the retail and H&M market should see a greater acceptance going forward. And we will also see a lot of products, as you know, DP more spoke about it, and we will have a lot more products coming out on that side of it, which will also open up the option for the investors. Today, they are limited by choice. Tomorrow, they will have a lot more options available to them.
Oh, yes, that's right. And they are getting new options every day to invest in, right, when it comes to mutual fund investing. Gentlemen, thank you so much for joining us today and making this discussion around smart beta investing easy for our viewers and giving us your insights as well. Well, with that, we'll take your leave on this edition of MF Corner, but you stay tuned for Closing Bell to take you through the last hour of trade.